Now for our last section on portfolio allocation. Make a plan. Decide how you will rebalance your portfolio. Things change. Either your life changes or your portfolio changes. And so you need to change the portfolio along with those changes. So to continue our wardrobe metaphor that we've started before, I recently transitioned into working remotely and moved to the mountains from Los Angeles. So that's a big change. I had to change my wardrobe. So no longer do I need heels. I got rid of almost every pair of heels that I own. And I need a lot more sweaters and warm clothes and jackets, and they're bulkier. So all my summer and lighter clothes had to go way deep into storage. I had to reallocate my wardrobe to meet my new needs. In section 3, we identified what your ideal portfolio is and also what your current portfolio is. So we want to change your current portfolio to meet and be your ideal portfolio so that you can achieve your goals. Let's talk about how we get there. We mentioned this in the last section. If you are a new investor, with a fresh start, you can build that portfolio exactly as meets your ideal allocation. Now, maybe you're a new investor and you want to be more hands-on. You're DIY. You want to roll up your sleeves and get dirty. Then you can take the advice that we gave in the last section. As you invest into different accounts, your retirement account, your post-tax brokerage account, your Roth IRA, you could, in each of those counts, make the allocation according to your ideal portfolio. Or you can look at all your accounts together and make sure that the allocation fits across all accounts. So maybe your retirement account, you know that's not going to be for another 20, 30 years that you're going to touch that money. So that's 100% in stocks. And then your post-tax brokerage account, that's your new house deposit down payment. So you know you're going to need that in 2 years. So that's more in bonds than cash, almost entirely, because you're going to be using that money soon. So you can also break up your accounts and allocate that way. Say that account is going to be stocks, that account is going to be bonds, that account is going to be cash. The most important thing is monitoring. Once you set it up, check at least annually. Things are going to shift over time because the market is going to change. So I like to always check my investments annually at the same point in time because there are weird anomalies in the market, right? You've probably heard of the January effect, the Super Bowl effect, right? These things have an impact on the market that are not explained. So when you do check your portfolio, try to do it within the same month. I like to do it in January because it's start of the new year. And if it's always in January, then I know the January effect is having the same impact every year. And then when you notice things are out of balance, you can follow the steps that we're going to go through in the rest of this section. Okay, maybe DIY is not your style for investing. You want to know a little more about money, but you want to spend as little time achieving your goals as possible. You want to be more hands-off. So as mentioned earlier, target date funds are a great, simple solution. They have them inside 529s. They have them inside retirement accounts. You choose the target date of when you want to use that money. So for a 529, your baby is born, you start investing and your goal is 18 years from now, they're going to be using that money. So you choose the target date that aligns with when you want to use the money. And the portfolio allocation is done automatically. So the fund looks at the date that you need to access it, and it uses algorithms and computer science to make sure that you stay in balance according to what is safe and appropriate for achieving that goal. They have very reasonable cost options. Sometimes you have to weigh the value of your own time, and you can set it and forget it more. It'll be fine. I still recommend checking annually, but you don't have to do the manual adjustment yourself. You do, though, have to make sure to keep in mind, don't forget it completely. You want to adjust if your timeline or goals change. Maybe when you were 20, you thought you would work for 40 years, so you chose a target date fund 40 years out. But then, you realize maybe retirement a little earlier would be great. then you want to look at your portfolio and adjust either the target date fund or the portfolio allocation. And some people even will adjust the target date fund based on their risk tolerance. So if they can tolerate more risk, they'll choose a target date fund that is further out than the date they need the funds, because they want to make sure that they stay more in stocks for longer. And then some people who are maybe less risk tolerant, they might choose a date that's closer in, but I wouldn't recommend going any closer in. The target date fund is very conservative. They're gonna use conservative calculations to make sure that your money is available and at the right amount when you need it. So I would only play with the date if you were pushing it out more and you had the flexibility in case things went awry. Like maybe you have a pension that you can fall back on if your target date fund isn't ready for you at the time of your retirement. Okay, so now let's talk about once you have a portfolio, once you have some of it. So here's the hands-on version of rebalancing your portfolio. So if you want to get in there and move your assets around to align them to your portfolio allocation, you have to make sure to take into account tax implications. So in some accounts, you can buy and sell assets and rebalance without any tax implications. So these are accounts like your IRAs, your 401k, your 403b, your 457, generally your retirement accounts. But you don't have to do it that way. You can change your future contributions as well. So maybe stocks had a banner year, your portfolio is way overloaded with stocks. So in your 401k this year, you're only going to buy bonds. And you know that over the course of this year, you're slowly going to rebalance your portfolio. So you can do it that way. Now, if you have investments in a taxable account, this is where you have to be more careful. These are investments that you bought post-tax. So you already paid taxes on them, and now you have an investment account at Vanguard or Fidelity or Schwab, and you're buying investments in addition to your other accounts that you have. If you sell assets in that account, you're going to have a taxable event, and that can be either a long-term or short-term capital gain or loss. So to keep it super simple, you could just rebalance with future contributions to avoid a taxable event. As you get more sophisticated, there are people who will use capital losses as a way to offset some taxes and things like that. But for you as a beginner, I would recommend maybe rebalancing with future contributions or looking at your taxable account as a part of your whole portfolio. Can you rebalance inside a tax sheltered account? So maybe your taxable account value has gotten to be very heavy in bonds. Well, can you rebalance stocks in your 401k to offset the bonds that are in your taxable account? So, don't forget that you have this whole pie you can play with. Now, we're going to just kind of talk through a math problem, right? So decide how you will rebalance and write it down, right? Let's make a commitment to that. Writing is such a powerful tool. When we put pen to paper, it helps us make a commitment. So what are you going to do? Are you going to rebalance immediately? Are you going to just take some bonds, sell, buy some stocks? Are you going to do that? Or are you going to adjust your future dollars to bring your portfolio into proportion? And then that's where you might need to spend a little bit longer to calculate how long is that going to take, and is it going to be a reasonable amount of time? And then we want to monitor at least once a year, right? There is also a little bit of your own tolerance for your portfolio allocation being a little off, right? So if you're 5% off on stocks or bonds, you could also wait it out and see how your additional contributions or additional spending balance it, reallocate your portfolio. But definitely the key point here is to monitor and to make a commitment to reallocating your portfolio, whether that be in the short term or the long term, to your recommended portfolio allocation so that you achieve your goals. Okay, and then there's a few alternatives that I just wanted to throw out there because I know this is really overwhelming to think about all these investments and taxes and trying to get them aligned with your ideal portfolio allocation. So, how do you eat an elephant? Bite by bite. So that might be what you do first. You might just start with one account. If reallocating your whole portfolio is too much of a task too soon, start with one account. Maybe start with your 401k where you know it's safe, right? And rebalance it using these strategies, right? Or open a new account. Start fresh. If you're eligible for a Roth IRA, you could open a Roth IRA. And as you make deposits into it, make the investments according to your recommended portfolio allocation. And then as you build your skills, you can rebalance other accounts you may own. Whichever way you decide to go do it, I a broken record. Revisit annually, revisit annually. Don't let your portfolio drift too far out of whack with your ideal portfolio allocation. And then, the limitation to this recommendation is that rebalancing each account takes more time than looking at your portfolio as a whole. And you often don't get the big picture of your whole portfolio. So it is really important that you see that big picture every time, every year, which is why I always recommend to look at least annually at your investments. And then, of course, we are here to support you. We have all of these great options for helping you work through this and figure it out. A financial coaching one-on-one, we can help you navigate all of your online investment accounts to see how to bring them together, either manipulate them in Excel or use an online tool to analyze your portfolio allocation. Financial therapy one-on-one if you find that there's some emotional barriers and issues that you want to address, and then investment strategy one-on-one if you want to get really into detail about the investments and their types and what you are invested in. That's also another great resource. A reminder that investing involves risk. Everything we talk about is informational and educational. Any examples are fictional and for illustration only and do not reflect what will or will not happen to you. We don't know your specific situation and aren't giving you specific advice. If you'd like that, please visit the service links that I just mentioned.